Hello, and welcome to the new unit to the national benefit series. Investment assistant professor in the Department of Customer Business Administration, student of the Field of Technology. Today, we begin with three financing decisions and capital structure. In Unit 2, we explore investment decision and capital budgeting, how firms decide where to invest their long-term capital. Now, in Unit 3, we turn to the other side of the coin, how firms raise their capital and some debt and equity they use. This is part 1, and we will focus on the foundational concept, leverage, operating leverage, financial leverage, and combined leverage. This first part, we will cover the meaning of leverage, operating leverage, its meaning, degree, and characteristics. Financial leverage, its meaning, degree, and characteristics. And then finally, combined leverage, the total impact. Let's begin by understanding what leverage means in finance. In common language, leverage means using a tool to gain mechanical advantage. In finance, leverage means fixed cost funds or asset magnified to shareholders. More formally, leverage is the concept used to study how different mixes of debt and equity affect the shareholders' returns. There are two main types: operating leverage arising from fixed operating costs, financial leverage arising from fixed financing costs. Together, they determine the overall risk and return profile of the the major types of the leverage: operating leverage, financial leverage, and combined leverage. Now we will see about the meaning of the operating leverage and the formulas. Operating leverage is defined as the use of fixed operating costs to magnify changes in profits relative to changes in sales. Think of a company, high fixed costs like manufacturing plant with heavy machinery. If sales increase, profits increase disproportionately because fixed costs don't change. But if sales decrease means profit also falls sharply. The key points of operating leverage are: it measures the proportion of fixed cost in company's cost structure. High operating leverage means more fixed cost relative to variable cost. Low operating leverage means relatively low fixed cost. It helps analysts understand how a company operation are linked to its revenue. I have mentioned the formula in this slide. Operating leverage, the formula is sales. This is the major formula. Sales minus variable cost equal to contribution. Contribution minus fixed cost equal to EVA. Operating leverage formula is contribution divided by EVAT. EVAT, which means operating profit, earnings before interest and tax. Operating contribution is the sales value minus variable cost value. Next, we can see the degree of operating leverage. The degree of operating leverage measures the multiplier effect of fixed operating costs. The formula for degree of operating leverage is mentioned in the slide. percentage change in profits divided by percentage change in sales or percentage change in EBIT divided by percentage change in sales. For example, if a 10 percentage increase in sales leads to a 20 percentage increase in operating profit, so the degree of operating leverage is 2, which means you have to divide 20 percentage by 10 percentage, so 20 divided by 10 equal to 2. So that's the value for the degree of operating leverage. Degree of operating leverage tells us how sensitive profits are changed in sales volume, a crucial insight for plan and forecasting. Next, we can see the characteristics of operating leverage. Operating leverage has several important characteristics. First point relates to asset side of the balance sheet. It's about how assets are used. Second point, it's directly related to break-even point. Higher fixed cost means higher break-even. Break-even means no profit, no loss. Third point related to selling price and variable cost. These determine contribution margin. And fourth involves business risk. The risk inherent in operations independent of financing. Understanding operating leverage helps manager make better operational decisions. Then we can see the meaning of financial leverage. Financial leverage is the firm's ability to use fixed financial charges like interest on debt to magnify the effect of changes in EBIT on earnings per share. It's sometimes called trading on equity because shareholders can benefit from borrowed funds. The key ideas of financial leverage are it is the use of borrowed money to acquire assets with the expectations that the return from those assets will exceed the cost of borrowing. For example, if a company borrows at 8% percentage and invest in projects earning 12 percentage, the extra 4% benefits shareholders. So the formula for the financial leverage is EBIT divided by EBT. EBIT already have said in the operating leverage, which means earnings before interest and tax. EBT means earnings before tax. PD. PD means preference dividend. T means tax rate. And the degree of financial leverage formula is percentage change in EBT divided by percentage change in EBIT. Percentage change in EPS divided by percentage change in EBIT. Then we can see the characteristics of financial leverage. First point related to liability side of the balance sheet. It means how the firm is financed. Second, shows the mix of financing methods, which means debt versus equity. Third, shows effect of changes in operating profit on EPS due to fixed change in financial charges. Involves financial risk is the fourth point. The risk of being unable to meet fixed financial obligation. Financial leverage can amplify both gains and losses, a double-edged sword. Next, we can see about the combined leverage, meaning of combined leverage. It brings together operating and financial leverage. It measures the total risk of the firm, both business risk and financial risk. It can be defined as the relationship between contribution and taxable income. It shows how a change in sales affects the earnings available to shareholders, passing through both operating and financial result cost. Next, we can see about the degree of operating leverage. The degree of operating leverage measures the percentage change in EPS resulting from a percentage change in sales. The formula for the degree of operating leverage is D2L into DF, which means percentage change in EBIT divided by percentage change in sales multiplied with percentage change in EPS divided by percentage change in EBIT. The combined leverage formula is operating leverage into financial leverage, which means operating leverage value will be multiplied with the financial leverage value. That's it. Or we can do it by the division like contribution divided by EBIT. We will get the combined leverage. Degree of combined leverage tells us the total sensitivity of shareholders return to changes in sales volume, a powerful measure of overall risk. And that's a wrap up part one of Unit 3. We have explored the three types of leverage operating, financial, and combined, and how they magnify the returns and risk. In part 2, we will see how these concepts are applied in EBIT EBS analysis to design optimal capital structure. If you found this video useful, please like, share, and subscribe. Leave your questions in the comments. See you in the next class. Thank you.